So someone I've been working with for a couple years reached out and asked, why is my dividend showing $0 for 2024? He's currently in the second year of his policy. He then said, I just want to make sure that the money that I'm putting into my whole life insurance policy is growing like it's supposed to. So his original plan was to fund a whole life insurance policy with a total of $300,000, and he wanted to do this by funding $30,000 per year for a period of 10 years. So that was his original plan, and so far he has stuck to that. He's paid a total of $60,000, and he's currently in the second year. So what we're going to review is as follows. We are going to look at the illustration that he was interested in. We'll see the exact product that he started with, and we have a current dividend interest rate of 6.10%. So we'll look at that and explain exactly how the dividends work in a whole life insurance illustration, and then we'll look at that same illustration, but we'll review the guaranteed values, and then we'll put it all on Excel so we can just see the net numbers and understand how it actually works. Excel can make it much more transparent. So let's begin with the actual life insurance illustration. So he's with one of the major mutual companies, as I like to say, good old Guardian, one of my favorites. And if we go down to the ledger statement, this will provide a breakdown of where his money is going, and also the dividend column and cash value column. So starting at the top, we see that he started at 23 years old. He was healthy and received the top health rating. His premium is $2,700 and change. However, we can see that he's then adding money into his PUA rider of 10x his minimum premium. Add the two together, it gives us a total of $30,000 per year. When we look at the funding going toward this policy, we can see it in this column right here. Net after-tax outlay, it shows $30,000 per year for a period of 10 years. After the 10th year, the payments stop altogether. He can keep adding money if he wants to. However, in this example, we're assuming he does not because he wants to get a total of $300,000 into the policy. Now his money column is the second to last column on the far right. It reads net cash value. And then we also have the net death benefit, which represents the dollar amount that would be paid to his beneficiaries if he were to pass. Now, his question was around this column, the dividend column. Specifically, why am I seeing zero for a dividend in 2024? He started his policy in 2023. Regardless of the year of when you start, when we look at the dividend column, what do we see here? The first year is zero. The second year, we start to see a dividend applied to the policy. It reads $1,298. So he's currently in year 2, but when he goes on his online account, the dividend still reads 0. Here's the reason why. You can actually see it in this illustration. This dividend column, what's the first word? End of year dividend. So he will get a dividend at the end of this policy year, year 2. The thing is, it's at the end. At that point in time, he will receive a lump sum payment of $1,298. So when it comes to looking at the dividend column on a life insurance illustration, always take note of whether it says end of year or beginning of year. Now, the dividend column is not transparent at all when it comes to the actual growth of a policy, and we'll look at that in a moment. What I want to hit on first is the fact that this net cash value is assuming that the company is applying a dividend rate of 6.10% to this policy forever. So this is based on the current dividend interest rate. However, what are the guaranteed values? Well, we can see that by looking at the supplemental numeric section of the illustration. I would not look at the tabular detail. The reason why is because this illustration, we've got the word guaranteed here, but it assumes that we don't make any changes to the policy, such as removing a term insurance rider, and it just shows something that is unlikely to happen. The chances of this happening is like an asteroid hitting the Earth. Like, yeah, not going to happen. Here's what I would look at. Supplemental numeric values. Here, we can see the custom guaranteed values. So to the far left, we see under guaranteed, funding, $30K per year for 10 years, nothing thereafter. There's the net cash value. And this column assumes dividends are never paid to the policy. So the guaranteed shows just the minimum guaranteed values. It is an absolute worst case scenario. So let's take a look at everything on Excel. Before I do that, actually, there's one very, very important item to note. When we go back to the ledger statement, when you look at the dividend column, what do you think that represents? Here's another way to phrase the question. This insurance company has a dividend rate of 6.10%. If you Google search Guardian's 2025 dividend rate, you're going to see 6.10% for 2025. 6.10% is their dividend rate. If I see the words dividend rate 6.1%, that is going to make me think that the column that says end of year dividend represents that interest rate of 6.10%. It does not. The reason why is because the life insurance industry is not transparent at all, in my opinion, when it comes to marketing and explaining definitions and terms. Here's the thing to be aware of. The dividend column does not include the guaranteed interest rate that is included in the policy. So for example, we've got a total dividend rate of 6.10%. The guaranteed rate, we'll just put a G here, is 3%. So what this column represents is everything in between the total dividend and the guaranteed rate, which is referred to as the surplus, which would be 3.10%. And if you were just looking at your illustration and trying to make sense of all this, one of the best things you can do is look at the cash value growth after you've stopped making payments. You can look at it when you're still making payments, but you've got to back your payment out. If we're not making payments, it's a bit easier. Watch this. So year 10, your cash value is $352. Year 11, you get a dividend of $6,716. Year 11, your cash value is worth $368,000, which, when we look at that increase, that's much more than $6,700, isn't it? Yes, it is. So what that column does not include is the guaranteed interest. It is only reflecting that surplus piece of 3.10%. And if you try to calculate 3.1%, it won't give you a net number because it's also a gross number. So if it sounds confusing, it is. Here's how we'd like to make it more transparent. We've got the same illustration we just looked at, but it's on Excel. So now we've got the annual funding, $30K per year. First year cash value, second year cash value. Okay, that's great. Here we go. Here's the dividend column. There's the number we just saw, $12.98 in year 2. Watch this. Here's your actual growth. Year 1, you pay in 30. Year 1, you have 26. I don't care if the dividend rate is 10,000%. I have a loss this year of $3,800 and change. Yes, I get life insurance, but if I am someone who is focused on the cash value, I'm going to look at this and say, I lost money in the first year. It's because you did. When I look at the year 2 growth, what I want to do is take the first year, 26,179. I add 30 to that. That would give me 56,179, but my cash value is 56,643. That means I got my 30K back plus another $464. This right here drives people nuts. The fact that I see this dividend of $12.98, but my money didn't grow by $12.98. It makes me think, what is going on here? And did the company get something wrong? Like, what's going on? So what's happening here? This dividend is a gross dividend. There are still insurance expenses associated with the policy. They're heaviest in the early years. So this dividend was paid to the policy, but after I back out the expenses that are also assessed to the policy, I'm left over with a net of $464. Think of it this way. You earn $100,000 for the year. That's your income. Then the IRS says, we're going to tax you on that. And you're left over with $70,000 after you pay 30% to the IRS. My point is, you've got expenses associated with the life insurance policy. Now, what you'll always see as we look at each year pass is eventually the actual growth will exceed the annual dividend column, because the dividend only reflects the surplus, whereas the actual growth reflects the surplus plus the guaranteed interest. So think of it as your net growth year over year. So here's what it looks like as time passes. Much higher than the dividend because it is including the guarantees. And if we go back to year 10, remember when we looked at this, we're at 352, we paid 0, now we're at 368. My dividend showed 6,700 and change, but my actual growth was $16,000 and change. That's what I wanted to look at. And usually you'll have to calculate this yourself, or the agent you're working with can calculate this. Not all insurance companies include this on a report. Some do. You can request, it's called a net cash value increase column that can be generated on an insurance illustration, which is nice. But what we usually like to do is just put it on Excel or write it out for someone. It just makes it a lot easier. That way they don't have to calculate it. When things aren't transparent, what I found to be very, very helpful is just try to make it as transparent as possible and try and have things color-coded, make it simple. This way people can see it and say, got it, makes sense. The last thing you ever want anyone to feel like is they're confused about their money. That never turns out well. All right, so that's the dividend rate. Let's move on to the guaranteed values. Here's the exact same thing. The difference is the dividend reads 0 because based on the guarantees, we get 0 dividends forever. That's why. When we look at the actual growth, what do you notice here? First 3 years, it's negative. After that, it's positive. What this means is I'm getting my payment back and some on top of it. So the actual growth is simply what we are getting from the life insurance company every year. That's the net dollar amount they're paying us in guaranteed interest, which is sweet. That continues to compound. Based on the guarantees, he breaks even year 7. And the guarantees represent an absolute worst case scenario, assuming he funds this amount as planned. So that displays everything in dollars. Let's wrap this up by looking at it in interest rates. So we've got the dividend rate at 6.10%. Then we've got the annual return. Just like what we looked at on the last tab, where we had the annual dividend and then actual growth, the annual return represents the net growth rate. So if you asked the question, what did I earn last year? And you want a percentage, I would ask for the annual rate of return or the annual yield, not the dividend. If someone says the dividend rate was 6.10% and they stop there and they don't provide the fact that the net return was less than that, you'll want to question them because this is your money. Where people get frustrated with this is when they are told, here's your dividend rate, or you earned 6.1%. And then they take a calculator and crunch their returns and scratch their head because they see that they're not actually earning 6.1% or whatever the dividend rate is, because expenses are assessed to that. Okay, so that's when I'm funding it. After the funding, you will notice the returns typically jump. The reason why is because every time I pay a premium, there are expenses and fees associated with the premium. Taxes are assessed on premium payments, meaning the insurance company has to pay taxes on premium payments. There's fees that come out. So when I stop making those payments, I don't have those fees. Therefore, there's less drag, if we want to call it that. And then what happens? Check this out. Get a nice little jump in the returns. And we can look at it as time passes, where it gets better for a long time. Then after about 30 years, the net returns start to gradually come down. People ask why. The answer to that question is I am receiving a constant dividend rate here. The dividend never increases in this illustration. And with the life insurance policy, as I get older and closer to death, there are expenses that gradually increase. Now, with the whole life insurance policy, my earnings rate, my dividend rate, and even my guaranteed rate will always exceed the expenses that are associated with the policy. However, if my crediting rate never goes up and my expenses do go up, eventually what's going to happen? Well, my net's going to come down. You'll see this always happen with bank-owned life insurance. It starts the second year, though. They start at the highest and then gradually come down after that. But they're still always net positive, which is why they put billions upon billions of dollars in cash value life insurance. All right, let's look at the same thing with the guaranteed values, and then we will wrap up with a few questions. So, same exact policy here. We're just illustrating the guaranteed rate, just like we were read when we looked at everything in dollars. Same thing here, but in percentages. We only earned $2 in year 4, which is why it says 0%. But where 3% is the gross guaranteed rate, we peak at a little bit more than 2.6% as far as the net return year over year. And this is typically just what people want to see. They just want to know how the dividends work, when they receive dividends, what's the net rate, what's the net dollar amount. Just don't play any games and try and make it look like something that it's not. So let's wrap up with a few questions that I would encourage you to ask when looking at a whole life insurance policy and you are interested in the cash value. Meaning you say to yourself, your agent, and maybe other people who ask, why are you getting whole life insurance? You say, for the cash value. Here are questions I would ask to avoid getting ripped off. 1. Can I see the guaranteed values? Not everyone is going to want to show this because it'll show the least attractive numbers. And as an agent, we might worry that we could lose the sale. However, it is your money. I would 100% ask for this. If a family member of mine or my cousin is getting a policy from someone else and I wasn't in the business, I would say, ask for the guaranteed values. They don't provide, ask again. Very important that you see that. Next, I would ask, can you show me the annual returns based on the guaranteed interest rate? Ask for that. Not everyone wants to show it. Next, can you show me the annual return based on the current dividend rate? Why I would ask this question is because it forces one to show the net returns, because it does not always come up in conversation. And where people have buyer's remorse is when they get a policy thinking that they're earning a certain percentage or it's growing by so much. They tell their friends, hey, I earned X amount of dollars or X return in my policy. And then it's brought to light, no, you didn't. And then they feel embarrassed. Like, whoa, that's what I was told. Was I lied to? No, it's just not transparent at all. So if you ask for the returns, it forces it to be laid out on paper in writing so you can see here's exactly what it is. And you don't have to take someone's word for it. And then they claim, well, it's not really what it meant. I said the dividend rate, and you got the he said, she said, which is never fun. People don't like that. Then I would ask, can you show me the same thing, being the annual return, but in dollars instead of percentages? This way you can see the net dollar amount you're getting every year. And why I would ask those questions is because the dividend rate is not transparent. The above questions will provide transparency. That's why. So with all of that said, I hope this helps, and thank you so much for watching. Have a great day.